everybody. So, the highly anticipated CPI data released this week after all the efforts done by the feds, and I am super excited to see whether this recent report showed any signs of a blow to the highest inflation in 4 decades. Well, let's find out. As you know, it's your rate slayer, Buffy. Yep, that's me, and I'm back with the second episode of the August 2022 Weekly Market Insight series, which is coming directly from our capital markets trading desk right here at SunWest Mortgage Company. Surprisingly enough, the U.S. inflation dropped unexpectedly. The second quarter earnings season is seeming to be much better than anticipated. The U.S. dollar dropped to a one-month low, and Treasury yields plunged across most of the curve, as traders seem to pair their bets on the amount of tightening that the Federal Reserve is likely to do in the coming months. The Consumer Price Index decreased 0.6% on a month-over-month basis, increased 8.5% from a year earlier, cooling from a 9.1%. June advanced the largest in 4 decades. Undoubtedly, this may take some pressure off the Fed's shoulder to continue aggressively hiking interest rates in the journey to tackle the inflation. So now let's see what else is under the surface. Another better than expected inflation report cheered the markets on Thursday. The Producer Price Index decreased 0.5% from a month earlier. This fall is for the first time in more than 2 years and largely reflects a drop in energy costs and represents a welcome moderation in inflationary pressures. Meanwhile, the U.S. productivity slumped for a second straight quarter, driving another surge in labor costs that risk keeping inflation elevated. Productivity, or shall I say non-farm business employee output per hour, decreased at a 4.6 annual rate this quarter after falling at a 7.4 pace in the previous one. Unquestionably, both CPI and PPI inflation were surprisingly dovish in July, but the recent wage and productivity data still signals price pressures ahead and would be the reason why the Federal Reserve is unlikely to step back from the inflation fight. U.S. average retail gasoline prices fell below $4 a gallon to the lowest since early March. Oil prices, the main driver of gasoline costs, have been in retreat as traders brace for recession and the U.S. government released crude from its emergency reserves to enhance supplies. Crude oil future West Texas Intermediate fall to trade around $94. Meanwhile, the optimism among U.S. small business owners finally improved slightly by 0.4 points to 89.9 in July. However, it still remained well below pre-pandemic levels and elevated economic uncertainty. The initial unemployment claims increased by 14,000 to 262,000 in the week ending August 6, indicating continued moderation in the labor market. So let's see how the housing market is doing, shall we? Rental costs in the U.S. are soaring at the fastest pace in more than 3 decades. According to a report, the single-family rent rose by a record 14% nationally in May from a year earlier. The rental affordability crisis in the U.S. is not new. It has snowballed over the past year as people return to big cities. The MBA Mortgage Applications Index rose 0.2% in the week ending August 5th after rising 1.2% in the prior week. Purchases were down 1.4% after rising 1% in the prior week. Refinance increased 3.5% after rising 1.5% in the prior week. The inflation report did stand in contrast to the stronger than expected July payrolls data last week. Therefore, the attention now turns to the comments from the Fed officials ahead of next week's Fed minutes. Let me share with you what they had to say. So, St. Louis Fed President James Bullard said that it was too early to say that inflation has peaked. Minneapolis Fed President Neil Kashkari commented that he wants the Fed's benchmark interest rate at 3.9% by the end of this year and at a 4.4% by the end of 2023. His Chicago counterpart Charles Evans welcomed the report, but added that inflation still remains unacceptably high. It's crystal clear that in spite of Wednesday's cool inflation report, the Fed's door is still open to at least a half-point rate increase in September. But a 0.75-point rise remains possible if subsequent reports of accelerating growth in jobs and wages point to significant income gains that could sustain stronger spending and higher prices. So that's all we have for the week. If you enjoyed this video, please hit the like button. And if you want to be alerted when we upload a new video each Friday, please subscribe. Your support is greatly appreciated. Please join me again for more market updates, figures of various important economic data, updated status of geopolitical nervousness, and much more. Stay updated with our news, and our trading desk will keep you informed with our pricing incentives. Have a great weekend, everybody. Buffy out.